Thank you, Vanessa. Thank you for inviting me. So, as Vanessa said, I'm Catherine O'Neill. I'm a director at Citi in the European Media Research team there. Now, our aim at Citi and on what we call the sell side is to help the investment funds think about which industries and which listed companies are attractive or not so attractive investments, which means I spend my time analysing listed European media companies, which involves the nitty-gritty of financials, but also thinking about the cyclical and the structural challenges and opportunities for the industry. And Vanessa asked me to provide some thoughts on the insights from the investor community in relation to advertising. Okay, so to start with, actually our worlds probably are fairly similar, although you might not believe it. Before we get into the detail, it's worth taking a step back to look at what's happened to the fund management industry and how this has shaped behaviour and feeds through to corporates. So our industry has been, and it is changing, much like the media industry that's come about due to the rise of technology and data. We liken the rise of programmatic buying in the media space to the rise of passive funds in our world. And both of these developments have put pressure on pricing. So active funds are funds that are managed by a team who use analysis to actively decide which stocks they want to invest in. Passive funds are data-driven and tend to track an index and are less people-intensive. Active funds are competing with passive funds for investors' money. And as you can see on this chart on the right-hand side, the money has been flowing from the active funds into the passive funds over the past few years. And the reason this has been happening is because the active equity managers have struggled to beat their benchmarks for several years. Access to information, technology and data means it's harder for them to have an edge. And the price differential between the active funds and the passive funds is significant. So the consequence of this in our world is also short-termism. The landscape and the competitive environment is changing, and it's certainly created tension, and that tension leads to this short-termism. And this is obviously a thread that runs across several industries now, and we see a ripple effect down that chain of command. This pressure influences decision-making, so the fund managers need to prove their worth. And that focuses their mind on the near term, and therefore they want a quicker return from the shares and the companies that they're investing in. Add on top of that, we have the rise of activist investors who have been putting pressure on company boards. And this filters down from the shareholders to the boards to the companies, which means there is pressure to deliver within shorter timeframes. And as we can see from the chart on the left, CEO tenure has been falling over that period. And so is CMO tenure. As I understand, CMO tenure is now barely 3 years. So this means companies are less likely to take risk and invest for the long term. And we can see this in the middle chart where you have CapEx investment. And the growth in CapEx has been falling over the last few years. So companies have been increasingly returning cash to shareholders. And the chart on the right shows there's been less share issuance. And in fact, in some cases, a reduction in shares, which means companies have been buying back shares, they've been increasing their dividend payouts, and more cash to shareholders means there's less cash for investment. So the advertising industry, as I'm sure you're all aware, is not immune from the trend of falling investment and that bottom line focus. Layer on top of the fact we've been in an environment where sales growth has slowed down, which is this dark blue line here. And we are in this have been in this low growth, low inflation environment. Now, how much of this slowing sales growth is due to lack of investment or lack of innovation or new competition or a lackluster economy, we don't really know. But we do know that generally A&P is linked to sales growth. And since the recession, advertising as a proportion of GDP, the chart on the far side, has been falling as companies have been looking for efficiencies. And digital, they think, has offered them that answer, which we will come back to in a bit. So this low inflation environment has meant the focus has also been more on promotion, i.e. price discounting, than it has necessarily been on advertising and brand building. And so in that context, we can't ignore that the brands do not operate in a static environment. The competitive landscape for many companies is changing. Retail and now parts of the pharma sector potentially are facing disruption from online platforms. In the broadcast space, we're seeing the disruption of that market from global SVOD players, and even consumer staples companies, which have been seen as defensive businesses in the past, are facing competition from more niche brands. Now, advertising is not seen as a barrier to entry that perhaps it once was for these new entrants. So if advertising is a cost, and if sales growth has slowed, does that mean advertising isn't working anymore? Now, the financial market has been trying to unpick what is cyclical and what is structural. And if we look at the consumer staples sector in a bit more detail, we can see this chart on the left. There have been market share gains made by new entrants, and they have come with limited traditional marketing support. And you can see the revenue growth of smaller cosmetic companies has been outperforming those of the larger brands by 4 to 5 percentage points a year. Now, the reaction of the incumbents here has been to preserve their margins in light of that shareholder pressure and also the slowing top-line growth. And one of those levers to do that has been A&P. So over the past 2 years, specifically, we have seen cuts to advertising amongst the largest, or one of the largest advertising category, the consumer staples. And this has come via this adoption of what they call zero-based budgeting, which basically means they start from the budgeting process from scratch every year, bottom up. You don't just carry on doing what you were doing the previous year. So this has led to a cut in brand support, and that's what we can see in the chart on the right-hand side, the light blue bars. And in the first half of last year, our consumer staples team estimates 90% of the margin improvement of that sector came from a cut to brand support and a reduction in A&P as a percentage of sales. And you can see also at the same time we've seen falling growth for that industry. Now, as you all know, the internet has also driven a change in consumer behaviour. So consumer time spent online has been increasing, as we can see in the chart on the left, and the money has been following the eyeballs. So the right-hand chart highlights that point. In fact, in the UK, online spend now exceeds share of time spent, with about 60% of the media market. So we have technology impacting not only the competitive landscape for large corporates, opening the door for new entrants with different business models. We also have technology driving down the time horizon by which shareholders and corporates are looking to generate returns, and we have consumer habits changing. And digital advertising has therefore flourished in that environment. Not only have eyeballs been moving away, but corporates have used it and seen it as a possibly more efficient media, offering the chance to cut out what they've seen as possibly wasted advertising spend because it's perceived to be, or was perceived to be, more measurable and more transparent. Now, the chart on the left is very interesting. This shows us in the US, we estimate the rise of the internet in the last sort of 20 years has led to $100 billion of advertising spend coming out of the market. So if the internet had not been invented, advertising spend probably would be a lot higher than where it is now. And digital has been the answer to justifying the cutting of costs, pushing down on pricing. And advertising was once seen as an operating expense, but it's increasingly become a cost of sale, which means it's become more performance-driven, more measurable, and ROI has to be assured. Now, at the same time, traditional media, as I'm sure you're all aware, has lost share. This has also been reflected in the market valuations as the financial markets factor in the challenge this presents, and we can see this in the falling valuation of ITV over the last few years. So we've laid out why we've seen the pressure on brand investment and how that's come from the top, essentially. But let's now look at the impact of that falling brand investment. And the evidence suggests that brands cutting investment has not necessarily been the right decision, and we might be reaching that realisation now. So the chart on the left shows there is a correlation between brand support and market share, and we think this has strengthened since 2014. The cuts to brand support may have actually exacerbated the structural erosion that they are facing and allowed the new entrants in more easily, and it may have contributed to that slowing top line. And this is some analysis our consumer staples team ran. So underinvestment in brands support, we think, risks long-term volume declines as new entrants gain share and get a foothold in the market. Now, the US food names were really the first to cut advertising 2 or 3 years ago. Now, it's hard to prove whether there is a link, but the table on the right-hand side shows you that organic sales growth for these US food companies pretty much slowed to zero over the last couple of years. However, at the same time, they were delivering the best bottom line, or what we call EPS, earnings per share growth, of all of the consumer staples subsectors. And that is because they implemented a very large cost-cutting programs and a very extensive brand rationalisation process. So that's great. And at that time, the companies are rewarded for delivering that kind of bottom line growth. But investors are only too aware that cutting costs is not a sustainable long-term strategy. And at some point, the company has to look to stimulate growth again. Now, that may come through more innovation, it may come through acquisition, or it may come through more brand support. And we have seen some of the US food names talking of increasing their share of spend on A&P again. Now, the question this all raises is whether A&P becomes more important in this changing world. And if barriers to entry are lower for the new entrants, then brand support probably does become more important over time, as brands have to be strong to survive. The challenge for the incumbent brands and the corporates, however, is they are viewed by the financial market through quite a different lens to that of the challengers, where the market is much more accepting of investment, much more accepting of losses. So the incumbents have the challenge of addressing business models, adapting to the changing landscape, as well as thinking about how to best position and support their brands. And this is the sort of final bit of evidence, I guess, and puts it all in context in terms of why investors really should care about brand value and therefore encourage profitable investment in brands. Now, I think the reason the market struggles with brands is because it is intangible, it's not something that's easy to put into their financial models, and therefore it's very hard to put a value on it. But this chart on the left-hand side shows you that the share prices of the top brands tends to have outperformed. So this is using data from BrandZ that our quant team put together and plotted against the share price performances against the market. And simply holding the top 30 global brands has nearly doubled your return versus the market. Now, there are a lot of companies in there now who are built on tech and are built on data and have become a growing portion of the top brands. And it's interesting to see that these brands or these companies often use traditional media to advertise and build their own brand. And the chart on the right shows this. So this is for TV advertising in the UK. The second largest category in TV in the UK is now the online businesses. So I've laid out here on this chart just some of the sort of opportunities and areas for considerations as we see it on our side of the fence as an analyst. We are removed from the coalface, so none of these are likely to be a surprise to you. I won't go through them all, but I think there's 4 that I think are sort of worth drawing out. The first one is we don't think short-termism will probably be going away anytime soon, necessarily. An abundance of data means that measurability and a performance-driven focus will continue. So using data to prove return on advertising investment on a fairly short time horizon is going to be important, whilst not losing sight of the value of having a strong brand. So really marrying those two. Secondly, it feels like the digital halo has slipped slightly over the past year. This is an opportunity for other media to highlight their worth. Digital was, as we talked about earlier, all about measurement, all about reducing wastage, but there's clearly quite a lot of data out there that suggests this hasn't quite played out as corporates perhaps hoped. So 50% of ads are potentially not viewed by humans. We've seen the rise of ad blocking, throwing up question marks about digital spend overall. It's no longer seen as experimental. It's become clear not all digital is equal, and concerns around reputational risk and brand safety are definitely something that have reached the boardroom level. One area we've done a lot of work on in our team is on the General Data Protection Regulation, the GDPR, that's coming in Europe in May this year, and the tightening of consent requirements around the ability for consumers to be tracked. This could benefit traditional media. We do think that companies that have a strong relationship with consumers will probably find life easier when the GDPR comes in, and companies that have a strong brand that consumers can trust. So it's a chance really to clean up websites in terms of all of the trackers that are now on there, and really take control that's being generated on company and media websites, and put that to good use. Use that to prove the effectiveness of the media. Thirdly, we expect to hear more and more about direct-to-consumer. Brands or products that have not had a direct relationship, and consumer staples is a good example of this actually, in the past, will be reviewing and repositioning their model. Some will have to move from a B2B to more of a B2C type business, and therefore communications will become more important. And they will need a strong band to ensure that they don't get lost, and there I think will be an increasing focus on consumer experience and thinking outside of the box as consumers play a bigger role in driving the direction of brands. And millennials in particular, I think, seem to be a big focus from brands. There's a lot of discussion about that amongst CEOs, as they're not so easy to reach as they were in the past in the traditional way. And then finally, the sort of fourth point I just wanted to draw on is that competition across industries is increasingly local as well as global. And so I think scale will become more and more important. We've seen mergers certainly in the media space, and there's even news of that this morning. And I think we may see more collaboration within media, and there may be even a chance that the regulator it becomes more amenable to some of the incumbent operators in the environment. So yes, any questions?
I do have a question for Catherine. Anyone else has, which is all industries we all have a bit of jargon attached to us, don't we? We all use words that no one else understands. Do you think the marketing industry is in danger of talking a language that the boardroom and the CEOs and the CFOs just don't understand? It just doesn't fit with how they talk and their language.
Yeah, I mean, I think in the sort of earlier days of digital, let's say, CFOs, CEOs were quite focused on, we're going to move money to digital, and they would quite often say, now 20% of our money is being spent on digital, and it used to be 15%. So, and they would talk about the number of likes or, those kind of metrics. I think 10, 20 years on from thinking about that shift and it being an experimental area, I think corporates and management teams, against the backdrop of having that low growth environment, are increasingly focused on where is my return. I need to see what the return on investment is. So I think it goes back to that point. If there's an abundance of data out there, if that can be used to really back up, what ROI can be delivered, then I think that's something that resonates in the boardroom. So really sort of hard data and hard evidence, because at the end of the day, CFOs are numbers people. Yeah. And much like analysts, if you can't put something in a model, then sometimes it's nice to know, but not necessarily essential.
So more ROI proof, and the more we can link it to profit, the better.
Yes, yeah.
That's lucky. Yeah. We've got some of that coming later this year.
Yeah. I mean, because advertising, I think, has become more of a cost of sale, which means you have had this shift to it being much more performance-driven, yep, which I guess digital has benefited from. But I don't think that will necessarily go away. I think because data exists, there's a view that you should be able to link it directly to some form of KPI.
Cool. Perfect. Anyone else got a question? There at the back, there are people with microphones, if you could.
Thank you very much, Catherine. That was an excellent presentation. It's Stephen Woodford from the Advertising Association. And I was very struck by what you said about, despite all the evidence, in a sense, short-termism seems like it's here to stay. Why do you think big firms almost ignore the evidence that actually it's, in the medium-term value destroying to be so short-term focused?
Well, I think it probably does go back to that, thinking about that chain of command. So I think because the financial industry, the investment industry is under pressure and therefore need to prove returns, then that narrows your, focuses your mind on a fairly short-term time horizon. And that filters down to boards. And I think corporates are very aware that you have the rise of activist investors, where if you're not showing an improvement in growth or margins or whatever it may be that you've committed to, that there is someone sat on the shoulder that will really, put the pressure on if that's not happening. And so I think, there is a bit of tension there, and I think that short-termism will continue. I think they will need to continue to show that they're delivering results, but also conscious that they don't want to damage the brand. I mean, I think the whole thing of brand safety and reputational risk has become a sort of big area of focus, very high up in companies as well.
Cool, and then there's one more over there.
Yeah, hi, Sue Elms from B Insight. The Brands E-chart shows that you take into account brand equity and the brand advantage that sits within those models. What sort of conversations are had around price premium? Because within that is the additional price that consumers will pay for those brands, and that's a key brand strength measure that could be a great KPI for media to prove themselves against. But how does that fit into your work and your considerations?
Now, growth in pricing is seen as fairly healthy. So as I was saying, we've been in a low inflation environment, which means there's been much more focus on promotion and pricing discounting and as the A&P pot tend to sort of sit together, you get a shift from A to P a period of time, and as we have more inflation, which we're in theory heading towards now, you should get a shift from P to A. So that sort of broader macro environment has an influence on the way that pricing goes. And actually taking a step back, I mean, investors are prepared to pay a higher premium for companies where they think there is a strong brand. So it goes back to that point about if you invested in the top 30 brands, since 2006, you would have doubled your return versus the market. So investors similarly are prepared to pay a premium for strong brands, like consumers probably are. But it's still about delivering. So as I said, some of these sort of newer entities are seen through a different lens by the financial market to some of the more, some of the incumbents. So the market is more forgiving of, investment requirements or losses in some of those businesses for a period of time, because there is a view that the longer term picture for some of those companies is sort of global scale and very strong position of foothold in their markets.
Brilliant. Thank you, Catherine.